So again, welcome to Accounting. Again, 101. We are going to be learning the fundamentals of accounting, which is going to be the backbone of everything that you need to know, especially when it ties into business. So I'm gonna go ahead and introduce you to the world of accounting as if you've never heard of it before. Okay? So this is taking it really back to basics. So introduction to accounting. So first off, well, what is accounting? All right. So accounting, or actually, what we're going to be learning in this class is we're going to be learning all these things right here. We're going to learn how to take a transaction and figure out how it's going to affect a business. All right. We're going to be looking at collecting data, analyzing, sorting, and then even posting them in their correct respective tables. All right. Not only that, we're also going to be looking at the rules and guidelines that govern our accounting. So it's going to be the generally accepted accounting principles, which I'll let you know now, it's only used in the USA. Okay. We're also going to be looking at, we're going to be overseeing what it's like to be a merchandising operations. So, as in, we're going to be taking a look at how to sell an item, how to purchase inventory. All right. Other things that are tied into that too, collecting sales tax. But also, we're going to be looking at creating financial statements. And lastly, I will also teach you a very, very, very small portion of payroll, how to process manual payroll. Now, again, these are all things that we're going to be looking into this class. So, behold, the next 15 weeks, we're going to be taking a look at all these topics. So, first things is going to be understanding the different business organizations. So, of course, when we look before we go into that, the most I guess thing that we need to understand is the nature of a business. Why create a business in the first place? And the ultimate goal here is to get any natural resources and either create a product or a service and provide it to customers, right? Another perspective, we want to make money. And that's the real thing down here too, is that you want to make sure that you maximize your profits and minimize any costs as possible, because ultimately the goal is to make money. All right? Okay? And that's the truth. That's the nature of a business, is to gain the money, right? You purchase an inventory item, and you turn around, you either modify it, package it, make it customizable to you, and then you sell that out to the public, and you charge at 3 times, 4 times, 100 times what it costs you to purchase the item in the first place. So ultimately is we're trying to do some kind of trade. So we're taking an item and we're ultimately converting it into cash. And that's our goal, is to always make a profit. Okay? So again, once we've done that, now we can understand there are only 5 types of businesses, right? Of course, there's a little more, like each one gets broken down into other ones, but the main 5 core that you should know is going to be a sole proprietor, a partnership, a corporation, a limited liability company, also known as a LLC, and then lastly, a non-profit organization. So each and every single one of these have some kind of uniqueness about them, about how they run their company, but ultimately they all have a goal. They all fit into 3 different business categories of business activities. And I'll talk about that afterwards, but let's break down each and every single one of these different types of organizations and go through them. So we're going to start with sole proprietor, all right? First things first is a sole proprietor. It's straightforward, right? Sole means one, right? So therefore, there's only one owner and one owner only, okay? And the only thing about this is that this means that the owner and the business man or woman are one. All right, there's no differentiations between them because the owner and the business is one. All right, that means all the assets and all the liabilities, everything that the company earns is going to be solemnly responsible by the owner. All right, that means if the company faults, that means the owner has to take fault for it. All right, and we'll talk about the pros and cons in a second. But other than that, the business and the owner is one. They're going to be considered one. Now, here's a little fun fact as well, too. If you do plan on pursuing a sole proprietor, right? Usually, it's always the basic one that you start off with. So the basic lines that you start off with, these are a small business company, whether you're a sole proprietor or a partnership, right? Usually, those are the steps before you can even become incorporated or be able to establish an LLC. I believe nonprofits, you can start up one, whether it's one person that owns it or multiple people own it. But we'll talk about that in a second. But here's a little fun fact. If you do plan on starting your own company, you need to know this, and this is very important, that the IRS is going to go after you in many, many ways. So if you submit as yourself as a sole proprietor, not only do you get a tax break because you're your own business, right? They are going to keep track of you. And if you do not make profits 3 out of the 5 years, you're going to be considered a hobby, and all that money that you've been getting a tax break for is going to hit you twice as hard. All right, so make sure that you know that, because the whole purpose of creating a business is, once again, you need to make money. And if you are a company that's not making money, all right, or barely making it by, all right, there are some certain organizations that can get by with this. If you do not make a profit within 3 out of the 5 years of being a business, it's going to be considered a hobby. So you want to be very, very careful. There's lots of rules and guidelines, especially when you start a business. All right, and this is just, it's just a little fun fact that you need to know. Obviously, if you want to pursue a real business, you definitely want to go to irs.gov and seek all the taxes that you need to have. Go seek a business advisor to go ahead and get you properly started. But that's just a little fun fact right there. Okay. So pros and cons. So the pros for being a sole proprietor is, number one, that it's the easiest and the most, and it doesn't cost that much. It's, I believe, if you want to submit a document or apply for a business license, it only costs $100, right? And all you need to know is you need to have at least a company name, and you need to, if you're the sole owner, you just put your name down, right? And they run your background, and they run your credit score and all that jazz, right? It's the easiest thing because you can just apply anytime, anywhere, and it only costs you $100. Right? Whether you get approved or not is where the question is, right? But it's the easiest way to start up the company with the most minimal amount of cost. Okay? Another thing is that the owner has full control to make those decisions. So again, because you're the owner, you get to run the whole business by yourself. If you like it this way, that's what you get. You get to have full range and full consent on every decision that you want to make. All right? So that's a good thing. All right? Third thing is that you also want to either, especially when you make those profits, the owner has a choice. The owner can either pocket the money that they earned from the profits, or they can reinvest it to their company. Now, of course, usually small businesses, you definitely want to reinvest in your own company because you don't want to take those profits out if it's going to hurt your company. Because again, when you build a company, especially for the first time and you're starting from nothing, right? You're going to be making all these business expenses. You need to purchase all of these assets. You're going to be building and more, and you may end up owing a lot more. So again, You want to be careful when you take those profits out. The best way you want to do to keep your company even being alive and whatnot is to reinvest in your company. And not only does that make your company even more valuable, it poses, it looks good in the public eye. All right. And again, like I've mentioned again, number 4, personal tax deductions, because you and the business are one. You get to take a tax break from this. So you get a huge tax break because you own your own business. All right. So that's what's really good about that. And then lastly, it's also easy to dissolve. So again, in this kind of case, the easy way to dissolve it is I'm going to stop my business. I'm going to just close my bank account and close my doors. Boom. That's it. And then, of course, you're going to have to notify the IRS to make sure that they don't keep track of you anymore, right? That's as easy as it is. You just close up the store, close out your bank account. That's it. All right? So those are the advantages of being a sole proprietor, right? You get full range of everything. You get to pocket all the money afterwards, and it's easy to form up, and it's also easy to take down. All right. Now let's talk about the disadvantages. All right. So disadvantage number 1: you are solemnly responsible for every liability and every single asset. Okay. So we will talk about the business and economic principle, right? And that tells you the difference between making a personal transaction and making a business transaction, right? In this case, the IRS will treat you as one, right? Because we said sole proprietor, you and the business are one, right? So if you owe a bunch of money and you can't afford to pay for it, they will go after your personal assets because you are 100% liable for every action that you do. So if you owe $100,000 because you made all these purchases, they can go as far as going after your home. So you want to be very, very careful, especially when you dive into this kind of type of business, that if you are going to make those executive decisions, right? You want to make sure that you also know that you're responsible to pay back these entities and to be responsible for everything that you own. Okay? So your personal assets are at risk. All right? And then here you go. That also ties into number 2, right? All personal and business assets are at risk. So if they liquidated your company already to try to get back the money that you owe, then they start going to your personal assets. So if you just bought a brand new car because you had the money for it at the time, they can go back and repossess it. So you want to be very careful when making those executive decisions. All right, so number 3, limited to using personal savings or a consumer loan. So for most small businesses, right, you may be eligible for, small loans, but you are actually only limited to whatever you can invest, right? So most banks, right, they'll look at you and they'll say, well, if they run your credit score and they see that you owe a whole bunch of stuff, like you owe a home, you owe other things, right? You can technically take the equity out of your home and put it into a business. But then again, if you do that, that means if you fault on your business, your house gets taken down as well. All right? So you want to be very careful with that. But also limited to only your own money or a small consumer loan. So oftentimes a good example would be when you apply for a business credit card. Most likely you'll get approved right away, $20,000, depending on your credit score, right? Because you and the company are one, so don't forget that. It depends on your credit score as well. Are you able to handle a $25,000 credit card, right? It could be even more than that. But that is going to be usually what you're limited to, all right? So everything that you got to do, you got to build it from scratch, all right? And you only are limited to so much money. Number 4 says does not attract high caliber employees. So We'll talk about this when we dive into payroll, but most likely when you're starting a business company, right, from scratch, right, and you're the sole owner of the company. One of the biggest expenses that you'll ever incur is going to be payroll, because it's something that you have to pay, whether it's every week, every other week, right? You have to keep that constant flow of cash and pay your employees, right? It's legal. It's illegal if you don't pay your employees, right? So that's why it's very low calibers, because you can't offer your employees that much stuff, right? Most employees, right, when they look into a company, they look at their benefits that they can have, right? They look at what deductions they can take out, especially when they offer a 401k plan, right? It gives them security. But in this case, if you're a small company, you might not be able to afford that kind of things. So with that being said, that means you're less likely to hire someone who's actually willing to work the job, and maybe someone that's just, trying to get any job at that point. All right. So most likely you're not going to get really good employees that actually want to do their job. They're more likely to be the one that just wants to just get the job done and go home. All right. And then lastly, number 5, employee benefits are not fully deductible to the business. So again, so this is actually tying into, if you do have those employee benefits, or if you do offer it to your employees, unfortunately some of them can be deductible, some of them cannot be. So especially for a small business, right, you might be able to get away with some a little deduction if you offer this type of benefit to them, but most cases it's not, they won't let you do it because you're just too small of a company. All right. So any questions in sole proprietor or about sole proprietor?
Once you become a sole proprietor, are you able to later in time have multiple owners of the company?
Absolutely, and that's why I say that usually the baseline that you want to start off with is either a sole proprietor or a partnership. So yes, as you gradually begin finding other partners, right, and that's the next part, you can go to the IRS and submit, or the local state government, and you can apply to upgrade your status from a sole proprietor to a partnership. And once you get that great status, right, that's when you can also jump from a small partnership to a limited liability company, or even be incorporated. But again, all of those things are going to come in time, right? You can't just start off as a incorporated company unless you have a licensed amount and you're willing to invest a lot of money. So there's a lot of rules about that when you are starting a company, but general rule of thumb is, if you're starting for a company that's from the ground up and you're a unique company that no one else has ever heard of, you would start either as a sole proprietor or a partnership. Okay? Yeah. All right, that's a good question. Any other questions? Okay. Moving on to the next one is going to be partnership. So when you start off as a partnership, right, there are 2 different types of partners. Okay? We have either a general partnership, or we have a limited liability partnership. So LLPs, if you've ever seen it, LLPs. Now I'm going to tell you the difference between the 2 before we go ahead and dive in what the pros and cons are. So the difference between them is, a general partnership is that every person, right, whether it's 2 or more, so you can definitely have a partnership that has 4 people, right? You just split the work or split the profits, however you agree, right? The whole purpose of the difference between a general partnership and a limited liability is that every partner is going to have some kind of percentage or some kind of equal share of the work. That's what we call general partnership, right? So that means they're equally liable for all their assets, they're equally liable for all the liabilities, and they equally split the profits. Okay? Where a limited liability partnership, you at least have to have one general partnership, just at least one. Okay? And then the other one is going to act as if they are a silent partner. So this is a very familiar term, right? A silent partner. Someone who just merely, their only role in the partnership is that they're just there for the investment. And their job is to not be involved in the company at all. Their only job is to collect any profits based on whatever percentage that you agree on. Okay? So that's the difference. Right? One of them is everyone's taking full responsibility, dividing up the work, dividing up all the tasks and the profits and whatnot. Where the limited liability, depending on how many general partners you have, they're going to do the hard work while you have at least one or two silent partners who are just simply there standing as an investor to the company. All right? That's the difference between the two. So now I'm going to go ahead and talk about the advantages and the disadvantages. Well, first one is the great thing about, once again, it is easy to establish. It is so easy to establish, right? Same thing. You can just submit an application to form a business, right? And then whether you get approved or not is what's going to happen, right? However, the only problem is that it's going to take a long time because, especially when you go into a partner that isn't someone that you know very well, if it's your best friend, okay, you may think you know them, but right when you go into business, you guys are partners, so there could be disagreements, right? So you guys have to equally agree and lay out all the terms and policies and make sure that if you guys are for surely going to go into business together, that you lay out what the responsibilities are, what the tasks are, and how much profits you're going to be sharing. And there's a lot of things that you have to agree on. You can't just walk into a business and be like, hey yo, hey yo, Mr. Sanchez, how about you and me do a business together, right? No, it doesn't work like that, because if you don't hash out those agreements in the very beginning, you may go into legal lawsuits and fight for your positions on what you own and et cetera, et cetera. So definitely that's the only thing, is that it's easy to establish, but the one thing is you have to make sure that you lay out what the responsibilities are for each partner and et cetera, and what they're involved in. Okay? And again, number 2 is their ability to raise funds, because not only do you have one person being able to do the sales portion, right? You can also have the other partner go and seek other funding, right? Go look for business investments, or even go have someone do a on-site, or they travel around and they become that sales commissions representative person, right? So you have twice as much power to earn the money that you need for your company. All right, and then again, tax deductions for profit. So because you're a small company, right, or in this case a partnership, you may get some tax deductions on those profits. Okay, I'm going to tell you now, I don't know the full details into it because I'm not a tax accountant. So if you'd like to know more, you can find out at irs.gov, or, if you want to, speak to a tax accountant and they'll be able to give you those, perspectives. All right. And then lastly, number 4, hiring employees that may possibly in the future could be a partnership in the making, whatever you want to call it, right? So for any reasons that you are, let's say you're an old couple and you own a small business shop, right? You don't have any kids, so you have someone that's been working at there for a good 20 something years, and you trust them, right? and you trust them enough to give them the company and have them, be either a part owner of the company or however you want to do it. Again, so that's why it's good to have those kind of employees, is that there could be potential that you could be a partner of the company. All right. Disadvantages, of course, if you have agreements, you're going to also have disagreements. All right. So again, you are responsible for your partner's actions. So here's a little fun fact here. If you go into an agreement with a general partnership, right, you have two people, right? If one person decides to make an executive decision without letting that other partner know, then that other partner can revoke that executive decision because they didn't know anything about it. So that's one thing that you can pose there, is that you guys have to make the decisions together. All right? But let's say if that partner made the executive decision and the other partner knew about it, then that holds true, as in that decision will go through. So there's the conflict there, is that if someone wants to try to go behind your back, they again, when you go into a partnership, you wanna make sure that you're going into a partnership with someone that you trust. But again, those executive decisions can pose a lot of conflict in your company. So again, both parties have to be agreeing on it, especially when it comes to making those executive decisions. So you can't have one person just overrule everything. It has to be a mutual agreement between the two of you. So that can pose many, many problems in a company, because what if I agree, like, oh, I want to paint my wall blue, and then Mr. Sanchez says, no, I want to paint it white, and then we get in an argument, right? So, that's the kind of agreement that you have to do, right? And then second thing is a disadvantage to this is all profits are shared. All right, so every time they want to go into business, right, they want to get the most money. In this case, you can't get the most money. You can only get half of what the company makes. So that's going to be considered a disadvantage, because you can't, as much as you really want all the money, you can't have all the money. It has to be equally shared. All right. Again, number 3, disagreements is probably one of the most dangerous things when you go into partnerships, because some agreements or disagreements can evoke potential splitting between the two partners. Okay. And again, some employees' benefits are non-deductible. So once again, you may offer some employee benefits. It may not be deductible to the company itself. And again, number 5 is limited life if a partner leaves. So of course, if a partner leaves, what do you become? You can't run a partnership without 2 or more people, right? So if you only have that one person, right, or those 2 people, right, and that person leaves you, then you become a sole proprietor unless you can find a new partner within X amount of days. I don't know what the legal term, withholding is going to be, but definitely you need to find another partner, or else you become subjected to automatically demote to a sole proprietor. Now again, that's the perfect opportunity, right? If your other partner was a general partner, you can go ahead and run the business yourself and find someone to invest in you, become a silent partner. So that's the most easiest way to get around that, is to find someone that is willing to invest and become a silent partner. Okay, but that's usually, yes, it does pose a threat if one of your partners does end up leaving. All right. Any questions about partnerships? Okay, pretty straightforward. All right. All right, next is going to be corporations. So here, let's go ahead and take a look at what a corporation is. So a corporation is going to be based on these 4 characteristics. All right. First one is shareholders are limited liabilities. So again, right? The company is its own entity. That means anybody that buys a share, right? They own a part of the company, but their personal assets are safe from the company. So if the company goes down for any reasons, right? The only thing that the shareholder has is whatever they are invested into the company. But as far as that, that's all they're limited to. They're not responsible for anything except for whatever they invested into the company with their shareholders. So that's one thing that you need to know, is that the company is going to exist as its own separate entity. All right. Other things here is there's a general management. So usually there's always a board of directors. So usually they are elected by the shareholders. So right, there's a shareholders meeting every either whatever quarterly, annually, whatever it is, right? And they elect people to entrust to go ahead and make those executive decisions on behalf of of themselves, to go ahead and run the company. All right, so that's going to be a general form of government. And then number 3 is transferable of shares. So once again, when you invest into the company, you own a portion of the company, right? If the company, right, makes an executive decision to go ahead and divide the profits, right, they're going to divide it through dividends. Okay? But most cases, they could do an executive decision to either put half the money back into the company so they can, do some renovations, maybe create a new department, right? Or they can just distribute the profits through dividends. Okay. And then lastly, they have a continuity, there you go, of life, okay, as long as there is at least one shareholder. Okay, so this company can last years and years and years as long as there's just one shareholder. So they can have 1 billion shareholders, or they can have just one, and the company will continue on with its life. All right. Now, here's also another little fun fact, is that the way that a company is incorporated, or decides to go from a small business to corporate status, is that it's going to be incorporated in the state that it was established at. All right. So if my company was in Atlanta, Georgia, then my incorporate status is going to be in the state of Georgia. Okay. So again, you can have multiple headquarters. Usually that's what they're for. Usually it's in the state that it was incorporated in. But if it's trying to reach other ones, then it can have other headquarters. However, the main headquarters is going to be wherever that the company has been established at. So that's a little fun fact there. Okay. All right. So now I'm going to talk about the advantages and disadvantages of being a corporation. So again, number 1 is shareholders have limited liability. Of course, that is great. That means not only do I invest in my stuff, nothing of my personal assets are going to be affected. So I've mentioned this before, right? So I can invest $100 or $100,000 into Target, right? Because they're a corporated status, right? But that means the only thing I'm at risk at is just my $100,000 that I invested in their stocks, right? That's the only thing I'm responsible for. So if they fall and they go down and they shut down, then I just lose that $100,000, right? Even though that's a big risk, but at least my personal assets, right? My home, my car, anything that is valuable, right? All of that is not going to be taken advantage or repossessed for any reasons. Okay. Another thing too is shareholders are only held accountable for their investment. So I just talked about that. Okay. Number 3 is going to be raise additional funds. Okay, so this is very important because if you've seen it before, right? A lot of corporations, right? They try to do give back to the community. Look at us corporations, right? We're not just big monsters, right? We invest and donate money to the St. Jude's, They try to throw all those type of fundraisers, or they sponsor, okay? So when I say sponsor, right, if there's something that there's a huge event going on, they'll sponsor it, and what that does is it gives them good feedback, and they be able to also gain money from that too, right? They can throw fundraisers, right, especially for those kind of things, right? Um, and again, they can find any ways to be able to get all that money back, especially when they release stocks. So that's the very most important thing, is that they're able to gain a lot of their money by simply saying, hey, guess what? I have a 2-for-1 stock deal. You buy one stock, I'll give you twice as much. So they're able to raise money really quickly by releasing stock. All right, so that's just one thing there, and that's a good thing there. Of course, tax deductions, they can actually, especially for employees, right? They can take the most benefits out of these tax deductions because they are part of a corporation, okay? And we'll talk about that real quick. So when I talk about this tax deduction, right? So here I'm going to go ahead and move on to number 5, is that they can elect how they want to be taxed. All right, as an S corporation. So if you've never heard of this before, you could have easily thought that an S corporation and a C corporation were two separate entities. They're not. They're essentially the same thing. The only difference is how they're being taxed, right? As an S corporation, you only get taxed once, only at the income level. Okay, so only personal income is going to be taxed at, all right? Where corporates, right? If you are a C Corp, not only do you get taxed at the personal income, you also get taxed at the corporate level as well. So most oftentimes, a lot of corporations, right, especially when they're paying tax and they're a huge $1 billion company, they're more likely to want to try to pay less taxes, obviously. So they would try to establish themselves as an S corporation. All right. Any disadvantages once again, is that it requires a lot of time and a lot of money, right? Like I've mentioned before, you can't start yourself as a corporated business, right? It takes time. You have to start as a small business, gain the people, gain the customers, then gain the investors. Once you get all of that going, that's when the investors, they think, oh, you're such a great company. Then that's where, once you get in corporate status, then other people on the other outside, right, not just investors, right, people, just regular people, they can go ahead and own a part of the company. And then that's where everything starts to go well, right? So that takes time because, again, imagine Target, right? They've been established way back when, and look at them now. How long did it take them to become so small to become big now, right? Second thing is that it is definitely going to be 100% monitored by the federal, state, and any local agencies. So we'll talk about this later on in this chapter about the Sarbanes-Oxley Act. But of course, it is very, very governed or watched by the federal, okay? Especially with corporations, because there's a lot of possibility that because the company's so big that a minor expense, right, could be easily overlooked. And that's where it's created many problems because oftentimes, people like Arthur Anderson, which we'll talk about, they take that opportunity to manipulate the company, and they create fraud. So because of that reason, that is exactly why the government, the federal government, the state, and every local agency, they're boggling down on these people. They're looking at them through a microscope and making sure that these are not corrupt businesses. All right. So the federal is the most important one, and their hands are always going to be inside the corporations. Okay, they're going to be overseeing them a lot because of those kind of scandals and rules. Okay. And then lastly, a disadvantage is if you are a C corporation, right? If you establish or didn't establish yourself as an S corporation, you have higher taxes. Okay, you are gonna get taxed twice. Again, once at the personal income level, and then again for corporate tax. Right? Any questions? Okay. All right. So the next one is going to be limited liability companies. Okay. So again, this one, it makes makes companies a little more likable in this sense, because the great thing about that is it allows you to not only protect your personal assets, but it allows you to be a hybrid between a partnership and a corporation. So the real key thing about a limited liability is that it must take two characteristics of a corporation, but still act as if they are a partnership. Okay, so it is, again, once again, it is not a corporation, but it is a legal entity that acts as if it has those two characteristics of a corporation. All right, so again, once again, those four components, once again, are that they either have shareholders, they either have a controlled type of management, they have some way to transfer the profits, or they just have some continuity of life. All right. So again, let's look into the advantages. So the first advantage is going to be taxation. They can be taxed at the corporation, and they have flexibility, right? They can be considered a C corporation if they wanted to. All right, so they have flexibility there. They don't need to be taxed twice. Again, they only can get taxed once, right? They are limited liability, which is a good thing, because especially if you're a partnership, right? If everyone is responsible and all of their personal assets are at risk, at least when you are a limited liability company, your personal assets are safe, right? It's only what you invest into the company, especially if you're a partnership, right? And again, you can elect one member to be the entity. So we talked about the general partnership, right? One person can just be solely responsible for everything, while the other partners, don't really do much. So yes, you can elect one person to just be the entity. All right. Again, no annual shareholders meetings are required. So again, if you do have shareholders, right, that's one of the characteristics of a corporation. You're not required to have one. Okay. And again, you have less administrative work to do because of less record keeping, because you're essentially a partnership, so you can have less work to do. So less things that you have to deal with when you're on a corporate level. All right. And again, you have membership interest can be assigned. So again, membership's interest. So anybody who's interested, right, you can assign them if you'd like. All right. Okay, so disadvantages of a limited liability company. Once again, you have to have at least two owners. So that, remember when we talked about partnerships, right? So because it's a hybrid between a partnership and a corporation, right, you have to have at least 2 people or more in order to establish yourself as a limited liability company. All right? And it can have a limited lifespan if one of those partners leave once again. And it may lead to self-employment tax. Okay? So, again, because if you are a partnership, it depends on what kind of business entity you establish yourself as far as what you guys do. All right? And then profits can exceed 50% will be taxed by the federal. So, because you are part corporate status, right, you got to pay your dues. Okay? Pay the taxes to the government. And can't take advantages of stock options. So if you guys, this is a little something that's a little advanced in regards to this, because when you go ahead and establish yourself as a corporate status, you can have what's called stock options, which you can take. It can be in place of either a retirement benefit, or it could be something that when you do retire, you still have a portion of the company with you. Okay? And that's one of the things that's a disadvantage, is that if you are a limited liability company, you cannot take advantage of, you cannot own a part of your own company. All right? Which is weird. I mean, it makes sense because there's only 2 people in there, or at least 2 people. All right, and then there are some state taxes for LLCs. So here we live in Nevada. We are subject to state tax here. But there are a few states that don't actually charge LLCs for those taxes. And of course, if you are planning to convert into an LLC, you may have to pay taxes on that. So again, I didn't talk about that for corporations because it's pretty straightforward. As far as corporations, you just need to make sure that you have enough people to be able to supply the shareholders. But again, you're going to be incorporated based on the state that the business established on, right? Of course, there's hoops that you have to go through when you apply to become incorporated status. But in this case here, you will get taxed for converting into an LLC. Okay? Any questions for limited liability companies?
On the note, what does it mean when it says no loss of power to a board of directors?
No loss to a power. Say that again.
No loss of power to a board of directors, although an operating agreement may provide for centralization of management power in a board or similar body.
Okay, so again, we talked about like a central government, right, or a central entity, like a board of directors. That could be one of the potential characteristics of a limited liability. So that only applies if you have that characteristic. Okay? And no power is basically like you can't override it. So it really depends like what character. Because remember, you can only have 2 of the characteristics of a corporation. You can't have all 4, or else then you become a corporate status. So it really depends. Like if you solemnly think that you don't need a central management, right, and you think that the 2 partners are good enough, then you don't need that central management. So those things will not apply if you do not choose that. All right. So yeah. Anyways, any other questions in regards to limited liability companies? No. Okay. We're going to go ahead and talk about the last one, which is non-profit organizations. So again, some of these things look familiar, right? PETA, not us PETA, but the animal PETA. We have the Comic Relief for, I believe that's AIDS. And then we have St. Jude's, which is for cancers for children. And then we have Susan G. Komen, which is for breast cancer for women. All right, so these organizations, their main goal of operations is to spread awareness on a particular topic. All right? And they want to try to spread this awareness to the public. So again, sharing knowledge to the public and having them in their favor to agree and want to join um, join the group as well. So it could be a cultural thing, it could be an educational, professional, religious, any of those types of categories, right? So these ones are all for something that they believe in, right? Animal rights, breast cancer awareness, right? Children with cancer awareness, right? So that's their main goal. And their main goal is to not make money. So they're the exception to the rule of a non-profit. They're not trying to make money. However, their main goal again is to educate, to spread knowledge for those purposes. And again, there is no absolute any owner when it comes to a non-profit organization, right? However, they do have a board of directors. Um, Again, and those are usually elected by whoever is involved. So anything that is going to be involved and how they get people to be involved is through membership dues. So if you want to be a part of this organization, you are subject to have to pay either an annual, a monthly, I don't know what they are now, but some kind of membership dues. And you have to attend their meetings, support, etc., etc. All right. And with that being said, they are funded either by the members themselves. They can get contributions by holding those events, right, to spread those awareness and have donations. And that's where a lot of the large companies that believe in these kind of things, they do large contributions to these organizations. Again, membership dues, fundraisers, and any federal state grants, right? So again, they if it's a company or a non profit organization that is something that is really necessary or needed by the federal or the state, or if anything, they can request for that kind of grant. And usually it's publicized, this event. Okay, and again, non for profit, and they get special taxes. So they are so unique because they are not in it for the money. They are just in it to just be able to have that money, so then they can produce the operations they need to in order for them to spread awareness. Now, yes, they can sell their own products. So, for example, right, they can sell anything with their logo on it. Again, that's not for to gain something. That's just to have recognition and to spread awareness, to have people know that someone's supporting them. All right. But again, with the money that the operations does is that they take that money and they have to obviously pay the people that work there. They have to pay for the event venue that they in order to hold their event. They need that money to do their operations in order for them to be successful in spreading the awareness. So, any questions for this? Nonprofits, again, they're all over the place. Any questions? Okay. All right. It is now 2:30, and let's do this one section real quick, and then I'll call a break. So here is business activities. So when we talk about business activities, it's basically, so once you've established your core business, right, or your business, what you are, depending on what organization that you feel fit. Okay, if once you establish that, now you have to understand, well, what kind of business activity do you offer? Do you offer a service? Do you sell do you sell a product, or do you make a product? All right? And these three things, right, you can intermix them. So if you offer a service and provide a product, or maybe you are the manufacturer and the seller of the product. So again, these are the typical three types of business activities that you see in all kinds of businesses out there. So again, service is pretty straightforward, right? If For all accounting firms, right? All their job is to advise you on your taxes or whatever it is, right? See, accounting firms usually do primarily taxations. So what they do is they offer their expertise, their time to help you create or file for taxes, right? They recommend you to do stuff. They tell you to provide all their documents, right? But they do not provide any type of product to you, right? They're solely based on their time. So usually that's what a service is. It's usually measured based on the time or the labor that they spend to provide a service for you. Okay? Pretty straightforward. Again, so examples would be any lawyers, okay, accountants, cable, obviously, and then yes, so that's the service aspect there. We also have merchandising companies, right? So anything that sells a product. So usually you have one or two choices, right? You would normally go ahead and buy the product at a low price, package it how you like it, and then sell it out to the public, right? So there are, two common ones I would say is a retail store. So any store that you can think that sells any product, right? So a clothing store, clothing stores like the clothing store, uh, grocery stores, anything that sells a product to you, right? They don't. What can a grocery store by any ways how can they provide a service to you besides tell you where the food is, right? So they're primarily going to be a retail store more so than an actual service. So they sell a specific product. And most of all those products that they sell are usually from other manufacturing companies. So that's where we're going to move on to the next section here. But looking at the two difference between a retail store, right? You sell them at an individual level. Like you sell them at one item at a time. Where a wholesaler, like Costco, you sell in bulk. All right, you sell the same product, but in large amount of quantities. Okay, and then that ties into the manufacturer. The manufacturer is the one that produces those items for you. So again, I believe Costco, right? They do have their own signature brand, the Kirkland brand, but however, they don't. At the Costco location itself, they only show you the wholesale side. They're not actually showing you the manufacturing side, right? But they are to both those kind of things, and they do provide services as well, right? If you go to their auto repair section at Costco, they do provide services, so they're all three. But for most cases, it's pretty straightforward, right? Do you provide a service? Okay, then you're a service. If you sell a product, you're a merchandising. If you create the product itself, you're a merchandising. So all three are going to be those types of business activities. Now, the one that we are going to be focusing on in this class is going to be looking at a merchandising company, right? I'm going to take you to go look at how to purchase inventory, right? Every time we make a sale, we need to cost out our inventory. And that's our main purpose of this class is where I'm going to take you to look through a merchandising company. Excuse me. So we're going to come back to this. So go ahead and take a break. Excuse me.
What time would you like us back?